Most people on the Nigeria stock market do one of these two things. They guess or they panic. Seasoned investors do neither. They use a system of valuation, volatility, and risk control. If you master these three, you will stop chasing the sure banker and start building your generational wealth with process. In the next few minutes, I'll show you a simple pro-style workflow you can use on the NGX. How to spot undervalued companies without falling into value traps. How to use volatility as your friend, not your enemy, and the risk management rules that keep you in the game long enough for compounding to work. First, cheap is not undervalued. Cheap can be a trap. Undervalued means the market price is below a sensible estimate of business value with a margin of safety. Here's the 3-lens valuation stack I want you to use. Lens 1, earnings power. Can this business sustainably make profit? Don't just ask, is profit up? But rather ask, is this profit durable? Look for consistency over multiple reporting periods, not just one good quarter. Lens 2, balance sheet reality. Can it survive Nigeria's macro shocks? Nigeria market environment can change very fast, like the FX liquidity pressure, FX rates policy, and input costs. It's on you to check the debt, finance costs, and any mismatch between what they earn and what they owe. Lens 3, cash return potential. Does this actually translate to shareholders' benefit? Profit is nice, but cash flow and capital discipline are the truth. If a company's profit is loud but cash flow is weak again and again, then please take a pause. Now to two practical valuation comparisons, simple, not academic. Compare the company to itself. Is today's valuation low versus its own history for a good reason or for temporary fear? Compare to peers within the same sector. Don't compare a bank to a cement company. Compare like for like. Before you buy cheap, run this 5-flag value trap filter. 1. Profit up, cash flow down repeatedly. 2. Receivables or inventory jumping without a clear business explanation. 3. Finance costs rising and quietly eating operating profit. 4. FX mismatch, earning Naira, owing dollars. 5. Governance noise, related party issues, endless one-off adjustments. If 2 or more of these are blinking, you don't argue with the market. You demand a bigger margin of safety or you skip it. Let's talk volatility. In Nigeria, prices can move fast, sometimes on fundamentals, sometimes on liquidity and sentiment. The pros don't fear volatility, they plan for it. Use either of these two methods. Method A, staged entries, the 3-tranche plan. Instead of going all in at once, you buy in stages. For example, you first buy 40%, then 30%, and finally the last 30%. You add only if your thesis is intact and the price becomes more attractive. This protects you from emotional buying and bad timing. Method B, barbell portfolio, the core plus satellites. The core 60 to 80% in quality names you can hold through noise. The satellite 20 to 40% also in higher upside ideas, but only with stricter risk limits. And here is a market structure detail that matters on the NGX. It uses index circuit breaker rules tied to the All Share Index, ASI. A 5% move in either direction within certain time windows can trigger a 30-minute trading halt, followed by an intraday auction session before continuous trading resumes. What that means for you is to avoid chasing spikes. Use limit orders and plan entries when the market is calm. Also, the NGX market structure includes limit up, limit down, LULD, style controls based on a securities reference price, and price limit rules can vary by security grouping. So again, limit orders and patience beat adrenaline. This is where most people fail, not in their strategy but in risk control. Rule 1. Position sizing. No single stock should be able to damage your life. A practical rule for many investors is to cap any one position so that even a bad outcome is survivable. Rule 2. Liquidity risk NGX specific. Some names are liquid, some are not. Wide bid-ask spreads can punish you, so your risk plan must include: if I'm wrong, can I exit without moving the market against myself? Rule 3. Thesis-based exits, not panic exits. You sell when the thesis breaks. When earnings power deteriorates, balance sheet risk is rising, governance changing in story, or valuation showing clear signs of being stretched versus fundamentals, or you have a better risk-adjusted alternative. Rule 4. Cash planning and settlement timing. Nigeria's equities market has moved to T+2 settlement, meaning trades now settles in 2 business days after the trade date. This change went live on the 28th November 2025. The practical implication is that if you sell today, your cash availability is not always instant. You have to wait another 2 days for your cash to be available. So plan your liquidity. Here's your checklist. Take a screenshot of this. How does the business makes money really? Earnings power, consistent profitability, cash flow, does cash match profit, balance sheet, debt, FX finance, costs manageable, governance, reporting quality and clarity acceptable, sector lens. What macro factor drives this sector right now? Valuation versus history and versus peers, margin of safety. What could go wrong and am I paid for that risk? Catalyst, what unlocks value? Entry plan, staged or single, risk plan, max position, plus thesis break conditions. Review cadence, quarterly fundamentals, not daily noise. This is for education only, not a financial advice. Always do your own research and speak to licensed professionals. Subscribe for weekly Moloney Street content on investing, financial freedom, and building long-term wealth for Africans at home and in the diaspora.